Hi, this is Laura Brown with the Rosko Group at Keller Williams Community Partners, and I'm here with Drew Huggins from Thrive Mortgage. And today we're going to talk about interest rates and how interest rates can affect your overall mortgage or your mortgage payment as a homeowner. So Drew, what is the prediction for interest rates for 2022?
So everything says that interest rates are probably going to continue to climb. They've been climbing over the last few months, but I'm not really hearing that they're going to be climbing a huge amount. So we may get into the low fours, the upper threes by next year. That was predicted to have happened by the end of this year originally. At the beginning of this year, they said we'll definitely be in the upper threes by the end of 2021. We're not seeing that yet. We're in the mid threes right now, low to mid threes, but it really seems like we're going to be probably in the fours by next year.
So how does the lending industry predict that this is going to be a trend, or how do you get that information?
Yeah, so we watch. So interest rates are based on mortgage-backed securities. So economists look at the economy. They look at mortgage-backed securities. Obviously, that's where they also look at the behaviors of the federal government, which last year is what pushed the rates down. The mortgage-backed securities were purchased by the federal government, which is what pushed the rates down so low last year. So really, it can be a little bit of an inexact science, because even predicting the economy can be, it's like, okay, these are the things that are going to go into the changes. But if those things don't happen, then somebody could be wrong. Dr. Ted, he's from Stewart Title. I listened to him on Twitter and kind of what he predicts, and he's predicting next year's probably going to be as good as this year as far as the real estate market goes.
Okay, great. So how does a change in interest rates affect a mortgage payment or your overall mortgage?
Yeah, so I wanted to do just kind of an example of where my purchase power would go today at the low to mid threes, 3.25 to 3.5, to say, what if the rate goes up to 4.5? So my purchase power would be today, if I were to have a $300,000 loan, whichever down payment, would be about a $1,310 for the principal and interest payment. That same $1,310 payment, if the rates go up to 4.5%, would only let you get a loan of $257. So that's really reducing your purchase power by, a little over $40,000. So that's pretty substantial.
That is a drastic difference.
Right.
So what can a potential buyer do to maybe help bring down their interest rate a little bit when they're actually applying for a mortgage?
That's a really good question. So interest rate is based on credit, it's based on down payment and the loan program. So one of the big ones is make sure that you have a lender that is willing and able to look at a rescore if we've got marginal credit. So if I've got somebody who comes to me and they've got 650, 660 credit score, but I can see very obvious small things that they can do to get the score up, I will do a rescore. It takes about a week. And that can help. That's a big one. Then the down payment does affect the rate, and it affects PMI as well. So if you can get to that 20% down, you're gonna remove PMI, and in certain loan programs, 20% down is actually going to be, oddly enough, a higher rate than putting 10% down. So you just have to have somebody that's willing to just take a look at all the variables, see where you are, and see what we can do together to get into a better interest rate.
That's great information. So for more information or to work with a great lender, contact Drew Huggins at Thrive Mortgage. And for more real estate tips, make sure you follow our YouTube channel at the Rosko Group at Keller Williams Community Partners.